second home for dependent parents or dependent grown children. Now, this is probably going to require a little bit of some definition and explanation as to what this means and why this can be important. Okay. First of all, let me start out by explaining that when people buy a home, there are basically three categories that home is going to fall into. The first category, and by far the most common, is what's called primary home. It is the home that somebody is going to occupy, owner occupied. That's what we think of most of the time, of course. People buy a home, they move into the home, and they live there as their primary residence. That's great. They get a homestead exemption, gives them a little bit of a discount on their property taxes. That's what we normally think of. So, primary home. Number two is second home. Now, second home, or we often think of it as vacation home, is a home that you may live in some of the year. In fact, by the way, by law, okay, by the underwriting guidelines, the guideline is you live in that home at least 14 days of the year. So if you had a lake house or a house in the mountains or some vacation spot, whatever it is, and you live in that home at least 14 days of the year, you can rent it out other times, short-term rentals, things like that, assuming, of course, that the HOA allows that or the city allows that in that area. We have seen a lot of that with those short-term rentals or Airbnbs or Verbos. There may be some regulations against it, but other than that, you don't have to live there the whole time. Second home. The third category is investment property, a rental property. This is a home that you buy and you're going to lease out on long-term leases. You have no intentions moving into it. Its sole purpose is from the get-go is to buy it, lease it out. Okay, I think we kind of get the gist of that. Now, by the way, that could be a duplex, a triplex, a quadplex, anything under 4 units, okay, 4 housing units. When you go over that, you're kind of in a multifamily situation, apartments. That's a whole different picture, different equation. Those are not very common. So quadplex or under, okay? So first of all, that's important you understand that. Now, secondly is all borrowers are going to get the lowest down payment options and the best interest rate options and best closing cost options on their primary home. That's just the way it works. For a vacation home or that second home or an investment property, there is always going to be an adjustment. The rate's not going to be as good. The closing costs are not going to be as good. And the down payment requirements are going to go up pretty significantly when it's an investment property. Okay. Now, that's where we get into this little clause, or this little carve out, little asterisk on all of this topic. When it comes to dependent parents, senior citizens, but they're in a dependent status, and dependent grown children. I'll explain that in a minute. By the way, on a primary home, you can typically, as a borrower, if it's your first time home purchase, you could get in for as little generally as 3% down. Now, maybe there's some special cases where you could do a VA loan and do 0%, something like that, or an FHA loan at 3.5% down, but that's a first-time home buyer. If it is not your first home, you can generally do a conventional loan with just 5% down. Okay. When you get to a second home, you generally have to do at least 10% down or more. And an investment property, generally, you've got to do at least 20% down or more. And the rates on both of those properties are definitely higher. And it has no reflection on how good of a borrower you are, how great your credit is, what your great income is, how low your debt ratio is. It is simply the risk associated with investment property and second home. It's just a matter of fact that Fannie Mae, Freddie Mac, FHA, VA, we'll just stop right there. But those entities are kind of like the governing body of lending land. That's really what the layman needs to know. They do a lot of things that are very important for our country and the housing industry in our country, but they make the big rules. And you want to follow the big rules because they got the best rates, the best terms. Okay, so it has nothing to do with you as an individual. It has to do with what you're doing at the property. And it's just a matter of fact. They know that if things went really, really south, you had a major catastrophe financially or whatever, people are going to pay the mortgage on their primary home before they pay the mortgage on their vacation property or their rental property. Okay. So in a worst case scenario, doesn't mean you're a bad person. It's just statistically, they know that's true. Okay. Here's where we get into the main topic, the meat of what I'm going to explain. Sometimes people will have maybe we'll go with the parent route first. They have parents who are getting older, they're aging, okay? And maybe they need to be closer to family. Maybe they're not going to go into an assisted living or a full nursing home situation, and they can live a little bit independently, but they need some help. And you want to keep them kind of close to where you live, okay? Close to family. Well, unfortunately, there's a little carve out that normally, if you buy a property and you're not going to live in it, well, it's an investment property or a second home, like a vacation home. But when you buy a property and the occupant is going to be parents, okay, that are dependent, financially dependent, okay, doesn't mean that they can have some income. Nothing wrong to have income. Maybe they have some Social Security. Maybe they have a pension, but maybe they just would not qualify to be able to buy that home. Okay, that would keep them close to you. Okay, well, there's a little carve out that says that you can have two owner occupied properties. The one that you live in, okay, as your primary home, and you can buy one that your parents live in. Okay, and you get the benefit of the lower rates and the lower down payment requirements. Okay, two major benefits that come into play. Okay, now when that's done, we don't get to count the income of the parents in qualifying. You would need to qualify on your own. By the way, there could be a situation where maybe you buy a house together. They're a borrower, you're a borrower. Okay, that could happen. There's pros and cons to that. I talk with clients about that in more detail, but sometimes you're just like, well, all they've got is Social Security and it's just not for them enough to live on. And I want to keep them close. So I want to help them be able to buy this other home. Well, the good news is you can get those better rates and better down payment requirements by doing this. Now, we as a lender do have to confirm that the parents are, quote, dependent. Okay, you can't just say they're dependent. We have to confirm it. Usually that's most commonly done by we get a copy of their most recent tax return, something that just shows what their income is, and just we run some simple math and we'd be able to prove that, okay, yes, indeed, the parents would not be able to qualify for this home. By the way, if they did qualify for it, well, then let's have them as a borrower. Great. That's a whole other equation. That's a simple owner-occupied home. But this is a nice option because a lot of times some people are going, well, I need a bigger house because I need to be able to have space for mom. Mom's getting older, or dad, or whatever, or both of them. Okay. Well, maybe that is what you should do. Maybe you do need to sell your current home and buy another one that is a little bigger. Or maybe you want to go this route so that you just get them closer. You kind of maintain a little bit of your own independent space. They have some of their independent space, but you're still getting them closer. Maybe they move into town for this or whatever. So that's dependent parent, a little carve out. That's a really nice one in certain situations. I have had borrowers do this. It does require a little bit of more explanation. Yes, obviously we do need a little bit of information from the parents, not a lot. And we of course want them to know what's going on. By the way, they could help out with the down payment some. I've had that happen. They can sort of gift into the home that they're going to be buying. That just helps your down payment. Okay. The other case, and this doesn't happen as often, but is if a family had a grown child that was maybe called a dependent grown child. Maybe they had a disability or some other situation in which they could kind of live independently, but they're going to always need a little bit of help from mom and dad, whatever that disability is or that impairment. Always having them nearby is going to be important to that family and to that grown child. Same thing can happen. We just have to document a little bit. What is the situation? Again, they could work, they could have some income, but again, we just have to prove they would not qualify on their own and what is the reason for it. Pretty simple to do. We document that. Real easy to do. And again, we could do it for less down and better rates and terms. So this is something that sometimes comes into play. Yes, there are other situations that sometimes we explore. Sometimes I've had situations where somebody wants to help mom or dad, or help them be able to get in a different living situation. And maybe they go, you know what? Mom and dad can qualify for the mortgage, but we've got to make sure the mortgage is under a certain amount in order for them to qualify. Well, maybe I've had situations where the person, maybe it's the children, the grown children, help out mom and dad with some down payment. Okay. And maybe there's another little family arrangement. Hey, mom and dad, y'all live here. It gets you closer to family. That's a positive thing for you and for us and grandchildren and all of that. And then down the road, yes, we'll inherit the house and we'll figure all that out in their will. So that's something that certainly could be done and could be considered. I've had that happen. I've had where they go in together. So it is the borrower, co-borrower situation. There's a lot of different options, but this is one of the really unique ones, because usually when I get this question, here's how it typically comes into play. A lot of times they'll say, hey, yeah, I want to talk to you about buying an investment property. Okay, great. So I talk to them, and then they usually will eventually tell me, oh yeah, we're going to lease it to my mom and dad, and we're going to release it to them at a reduced rent. And that's usually how they've presented the situation. And I go, oh, hey, I can totally help you do that. If you want to do it as an investment property and you want to lease it out to them that way, that's fine. There is a better way to do this. You can still charge them rent, whatever that is, but doing this gets better rates, better down payment options. And a lot of times they've never even heard of it. So real positive. This is a quick one. Doesn't require a whole lot of full explanation here. Hey, if I can help this, we're seeing this more and more, where sometimes there's housing needs that are multi-generational. And we're probably going to see more of that, as housing prices go up, as just different living situations take place. And if I can ever help, or you want to discuss this, let me know. You'll see this QR code over my shoulder here. Feel free to click on that. My full contact info is there. I'm happy to arrange a time to talk. That's free. Doesn't cost you a dime, and just kind of share more or hear more of your situation and maybe give you some thoughts on what would be best options for you in your situation. Hey, I hope you have a great day. Bye-bye.